Hello folks, Steve Lentz here with Discover Options. Welcome to this presentation of three different reports. For those trading condors and butterflies, we have a timing report in the S&P 500 for you guys. For those of you trading bull put spreads in the SPX, we have a timing report for you. And then those who just want to know the directional likelihood of the market going up, down, or wobbling around a bit, we have a directional likelihood report. Now, presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get to these reports, just want to make sure that you know you can subscribe. We'd appreciate that. That way you get notified when we come out with a new presentation. Also, we have an ebook for you, a free ebook co-authored by myself and Jim Graham. Simple steps to option trading success. Just click the link, give us your information, we'll get you that free book. Before we get to the reports, it's important we know what the current market condition is. Take a look at this. We define it in three aspects: price action, trend, and the stochastics. Price action, Thursday was an inside bar, and then Friday was a downswing bar, if you look real closely there. Now, that price action took place when the trend is upward, where the SPX is above its 50-day simple moving average. In terms of the 15-3 stochastic, it is trending down underneath its 3-day %D, and it is lying between 30 and 70. Now, when you combine all of that, that's a very unique market condition that has existed only about 23 times since Jan of 2000. Not that much. So let's keep that in mind. Let's get to the first report. The S&P 500 Condor and Butterfly Timing Report. Okay, so since Jan of 2000, there have been over 4,300 daily closes of the SPX. Now, of these, 65.2% have been favorable bars for selling option premium where the actual 21 bar movement, okay, was less than the SIBO skew adjusted implied movement. See, and that's favorable for condors and butterflies. When the market moves less than what is being implied, that's a good thing. So if you could flip a coin in the SPX and you'd have 65% probability of coming up with a bar that it turns out to have been favorable. Now, also during that time, since Jan of 2000, as I mentioned, our current market condition has occurred 22 times. Now, of those 22 times, 63.6 of those bars turned out to have been favorable, pretty much a wash. Technically, we have a negative edge of 1.6%, but it's just real close, just really close. So statistically, technically, it's more likely than usual that the current market condition will end up being unfavorable for market neutral option premium selling. Okay, so you have a coin toss of 65. Of the 22 that we have in the current market conditions, about almost 64. It's right in there. That's the Condor Butterfly Timing Report. Okay, now for those of you that like to go bullish and you sell out of the money put premium and say a credit spread, maybe you do a credit spread there and you hedge it with an at the money bear put spread, something like that. Some of you also do out of the money put butterflies and you bend those bullish. This could apply to you folks as well. So here's the bull put spread timing report for the S&P 500. So since Jan of 2000, as I mentioned, we've had over 4,300 daily closes. Now, of those 4,300, get this, 82.8%, okay, 82.8% have been favorable bars for selling put premium, a standard deviation out of the money, where the actual 21 bar downside movement was less than the SIBO skew adjusted implied movement to the downside. So we take the VIX, we apply the skew to it to come up with a bit of a fatter number to the downside. That's the implied move to the downside. The market is moving less than that 82.8% of the time. You could flip a coin, and if you sold put premium, a standard deviation out of the money, 30 calendar days away, 21 trading days, 82.8% of the time you'd have you'd be correct. It doesn't hit your short strike. Now also during that time, as I mentioned, we've had our market condition occur 22 times. Now look at this. Of those 22 times, 90.8% of the bars turned out to have been similarly favorable for put option premium selling. A little over 90% of the time. This implies a put option premium selling edge of 8%. So statistically, it's more likely than usual that today's bar, or Friday's, will end up being favorable for selling out of the money put premium. Okay, so that is that report. And of course, the way I do this is I have Metastock going. It took me a few years to come up with the indicators, the interlocking indicators. There's a couple hundred of them for me to get this data. Wasn't easy, but it's quite a feat, and I think this is valuable information for advanced option traders. Finally, we go to the market likelihood report, and this is a picture of price distribution. And what we're doing is looking at the price distribution that occurs on a baseline basis, and then we look at those 22, 23 occurrences with our current market condition to see if the distribution of price is bullish or bearish, and we compare it to the baseline. All right, I mean, think about it. If you have a bullish setup, maybe there's a breakout to the upside after a congestion or something. All right, you would want to, instead of just looking at a trading system to exploit that, wouldn't you want to just make sure that at least you have a price distribution historically with that signal that is bullish? That the prices distribute themselves over the course of several occurrences, upward? And that's kind of what this seeks to look at, okay? So what you're looking at here then is I use distribution bands, 5, 10, and 15 days to the upside, 1 standard deviation up above the close. I also have a band that's 5 days, 1 standard deviation out underneath the close, 10 and 15 days. 6 different distribution bands, and they're getting struck at different paces. But I want to show you this, okay? Just as an example here. So here is, and this is from a few weeks back, here's the close. We have the 5-day upper band, the 5-day lower band. Now notice that the distances are different. The upside band is closer than the downside band. And this is because we're using the skew adjusted VIX. We're not applying the VIX to both the upside and the downside. Okay, the SIBO publishes an item called SKEW, the skew. It pertains to the vertical skew, where the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. And that's being reflected here, where there's a lower volatility input going into determining the width of the upward band, and there's a higher volatility going into determining the downside 5-day band. So not only do we look at 5-day bands, but we look at 10 and 15. And the question is in this case, from this close, is price going to go up and hit the upper band, the lower band, or wobble around and stay in the middle? Will it hit the 10-day band 10 days out, sometime in the next 10 days? Will it hit the 15-day band, sometime in the next 15 days? So now let's go look at the report with that in mind. So we can see here that the S&P 500 has struck the upper 5-day band. Of all 4,352 closes, it has struck the upper 5-day band 21.4% of the time. The upper 10-day band, almost 16, upper 15, almost 15% of the time. It has struck the lower 5-day band, 16.7, 16.8. Finally, the lower 15, almost 20% of the time it has struck that. Now, that's the baseline right there. That's the baseline. Now, let's look at the 23 occurrences that match our market occurrence. Notice that of those 23 occurrences, price ended up moving up and hitting the upper 5-day band 17.4% of the time, which is less often than the baseline. It struck the upper 10-day band just 13% of the time, which is a little bit less than the baseline. It struck the upper 15-day band 13% of the time, which is less. Then look at the lower bands. It struck the lower bands less often, less often, less often, less often by a bit more than the upper bands. Do you see that? So if you wanted to bend this bullish or bearish and make a prediction, well, all we could say is that the likelihood, given this pattern, is that we know that it has struck the lower bands much less often than the upper bands. All right, and the difference in the lower bands is greater than in the upper bands. But overall, this is a picture of lower market volatility. Now, should price exceed Friday's high, the distribution is different than if it were to exceed Friday's low. And that's what I went. Of those 23 occurrences, 7 times it exceeded the previous day's high. And the distribution in this case was a bit to the bearish side. The upper bands were struck way less. Look at it, 0%. Way less often. And then the lower bands were struck a little bit more often in that case. Now, when you come down here to the, if price exceeds Friday's low, okay, we could see that the upper bands are struck a little more often, and then the lower bands were struck a little bit less often than baseline. Now, keep in mind too, folks, we're only talking here about 23 occurrences. Okay, that's not that much. I like to see a lot more. So we just issue that disclaimer, of course, but I think you get the idea. And even though we have a rare market occurrence, I'm going to go ahead and report on the statistics anyway. All right. Thanks so much for joining us. I'm Steve Lentz with Discover Options. Have a great week trading. Thanks for joining us. Bye-bye.